When the annual energy outlook comes out, and also when the international outlook comes out, a lot of people look at it because it's the reference guide to what goes on in the world. So it's energy markets looking at economics, trade flows, price bands, and other factors that influence both supply and demand.
Partway through the modeling period, we had a big change in the crude oil price outlook and general situation. So we have significantly lower prices in the near term in the AEO 2015 for crude oil. But as you can see in that graph, by the time we get to 2040, we're back pretty much to where we were in the 2014 AEO, where you have total energy use going from about 97 quadrillion BTUs in 2013 to about 106 Qs in 2040. Most of that growth is in consumption of natural gas and renewable energy. CO2 emissions are sensitive to the economic growth and energy price trends. And in the reference case, we're still below 8% below the 2005 level that you see, that peak towards the left-hand side of the graph. High economic growth leads to more fuel consumption and greater CO2 output. Low economic growth is just the opposite. On the production side, this is not a lot different than what we were showing in 2014. Three big sources of future natural gas production growth in order of importance: shale gas, tight gas, and Alaskan gas. The Marcellus and Utica together will have cumulative production in our model that's greater than the combination of Haynesville, Eagle Ford, and Barnett over the forecast period. So the shift in gas, the center of gravity for natural gas production, is really shifting east. Consumption side of natural gas, really driven not exclusively by any means, but certainly the bulk of the growth and the majority of the growth in natural gas is coming out of electric power. There's also a pretty big increase in what happens in the industrial sector. Drilling down just a little bit into the industrial sector, food processing, bulk chemicals, refining, and kind of general manufacturing and metals smelting, big consumers of natural gas and providing a lot of the growth in this sector. One of the key differences across the cases is how much natural gas is exported from the United States, and that's going to depend very much on what U.S. natural gas prices are and what world energy prices are, basically that spread. The electricity mix, looking at this over time, shifts to lower carbon options. I mentioned in my introductory remarks that renewables and natural gas taking the most market share in terms of generation. In general, the more likely market for U.S. LNG exports is in Asia, not Europe, just because of the prices. But that markets do shift around, and a lot of this is really not up to the United States. In general, could exports of energy, whether that's petroleum products, crude oil, condensate, natural gas in the form of LNG or pipeline exports to Mexico, will they make a difference to the global balances? Yes. And does that have geopolitical consequences? Yes. In a sense, I think you could say Europe might be better off even if U.S. exports of LNG were to go to Asia, simply because there would be more natural gas on the global markets.